So YouTube, today I'm gonna explain got time cycles. So basically there's 270-minute time cycles, 90-minute time cycles, and then 30-minute time cycles. And all of this is fractal, so you can use what you know on the 30-minute to then use the 90-minute, and then for the 270. So first we'll go over the 30 because it's pretty much the same thing across all cycles. I know the colors are weird, but this would be a 90-minute, and then this would be a 30, 30, 30, 30, and then this big one is the 270. But basically, once you have your first 30-minute cycle, there'll be a high of that cycle and a low of that cycle. And so basically, what the algorithm is gonna do is first it'll sweep a high of it, and then once it sweeps the high, it then goes to the low of the cycle. As you can see here, swept the low, and then it'll go for, you can tell, like, here, let me show you how I used it today. When you have a low of a cycle, and then you see a candle close below the low of the 90-minute cycle, you know price is going to go to another draw on liquidity. I just delete the indicator. And basically it went for this low right here. I actually probably went for a lower low. Yeah, I went for this one, but my target was this low right here for today's trade. And I'm gonna show y'all how you can use time cycles. It's pretty much like time cycles can be used as like a point of interest of liquidity, because you know once it sweeps out the low of the 30-minute, it'll go for like the high of the 90-minute or the high of the 30-minute cycle, and you can kind of use that to sorry, get a better conclusion on where price is headed. So you can see, once you saw this 30-minute cycle sweep out the low, and then you have this next 30-minute cycle, and then instead of like kind of like wicking and like, I'll show you, instead of like wicking to the top of the time cycle, you can see right here where it just wicked, took the high, and then closed below that high. So basically, what I mean by that is basically, if you have a high, let's say it would be, I guess for this we could use, we'll use a low. Never mind. Scratch that, because you can use the nearest high or the nearest low that is swept. So let's say, I guess the lowest low would be this one right here. So that's the low of that 90-minute cycle. You can see, like, instead of wicking down, taking it and closing, coming back up, it closed below this candle. So you know price is going to go for a way lower draw on liquidity. which would be this, or this time here. But you could also use the time cycles. They will react off the midpoints of the previous time cycle. So it'll have like bounces off of it to then go higher. Or once it closes above it, price is going to go higher. And then basically just use time cycles as like points of interest of liquidity. So like, let's say you see, oh, the high of this time cycle just got taken right here. Boom, this 30-minute time cycle, the high just got taken. Now you're like, oh, maybe the low of that time cycle will get taken too. So you just watch, wait for an entry. You could probably go to the 1 minute. And be like, so the high just got taken in that time cycle. And then you're sitting there, oh, we got a an order block, or a breaker box, whatever you want to call it. Price went down, came back into it, closed below the 50% level. You're like, what's my nearest draw on liquidity? Probably the low of this 30-minute time cycle. So it's kind of confusing, probably really confusing, because I just learned this and I'm trying to explain it the best I can. But just try and think of it as, once it takes the lows, or once it takes the high of, like, let's say a 30-minute cycle right here, swept the highs of that, and then you could look for maybe a retracement down to the lows of that 30-minute time cycle, or this would be a 90-minute, to the low of that 90-minute time cycle, and then that would, and then you would see if it wicks and just takes the bottom, because if it takes the bottom, it'll go for the highs again. So you could see if it either wanted this, or if it wanted a draw on liquidity that was from like a previous day, or previous, like a week ago or something. Because I think this was, yeah, that was like Monday, so that's a couple days ago. But I'll try to show you another example. That's not a good one. It's not a good one either. There we go. So you can see we had the highs of this 90-minute cycle, and then got swept by this 90-minute cycle. So then maybe you could look for your next 90-minute cycle, which would be this blue one, to then sweep the liquidity of the bottom portion. Well, yeah, you can kind of use it to just like another way to try and predict price, to move to what high or low it wants to go to, because it's kind of really hard to find a draw on liquidity, especially in like our market moving like up and down like this. You could be like, oh, you got the midpoint right here, it's supposed to have, 30 minute. Okay, never mind. But yeah, the midpoint of this 30-minute kind of came up to it, then bounced off of it. See the midpoint of this one came up here, bounced off of it, then broke through it. And then look right here. If you look at the midpoint of this previous time cycle, you can see price came and bounced off of it perfectly. But yeah, sometimes it'd be working, sometimes it's like not the best, but you can see like it'll take the high of it and then go for the lows of the time cycle or the previous 90-minute time cycle. But it's just to get you like points of interest or points of liquidity. But yeah, and a good indicator for this is this one right here, and then these are my settings that I like. But yeah, that's my best way to try and describe time cycles. Probably pretty shitty, but yeah, I'm sure you somewhat get it. I hope. Like it sweeps the high of it, you go for the low of it. I don't know. I feel like it's pretty good. It's pretty simple. Like, I'm not trying to overcomplicate it. Like, I swept the high of this 30-minute, so you can see this 30-minute, then consolidated, bounced off the midpoint, consolidated, and then this one took out the low of this one, and then this next one took out the lows of these 90-minute, 90-minute, 90-minute. And then this 90-minute closed below, so then it wanted a lower draw on liquidity, which would be right here, came down here, and also wanted, I think it wanted the low of this cycle, yeah, came and swept that too. But yeah, that's just, I'll probably drop a better video later on it, but yeah, that's all I got for right now. I'll see you on the next one. Deuce.